Hello, good afternoon, everyone. Have a nice day to all. I'll be sharing with you our topic for today about cost volume profit analysis. Okay, so what is cost volume profit analysis? So CVP stands for cost volume profit analysis. CVP analyzes, explores the relationship between revenue, the cost, and volume, and their effect on profits. Based here, we have the profit equation. The income statement, total revenues minus total cost is equal to operating profit. The income statement written horizontally, we have here the formula, operating profit is equal to total revenues minus total cost. Therefore, here, our profit equation, total revenue, to compute total revenue, is equal to average selling price per unit, or the selling price, P or SP, the selling price, multiply by the units of output produced and sold, the X. So TR, the total revenue, is equal to PX, the selling price times the units of output produced and sold. For total cost, variable cost per unit times units of output, that is the X, plus the fixed cost. So therefore here, TC stands for total cost is equal to total variable cost. You have your V multiplied by X, the units of output, plus the F, the fixed cost. That's the sum of total cost is the total variable cost and the total fixed cost. So here, therefore, the equation, profit is equal to total revenue minus total cost is equal to your total revenue, TR minus TC. So your TC is equal to VX, your total variable cost, plus your fixed cost. Therefore, profit is equal to PX minus, open close parenthesis, your VX, your variable cost, plus fixed cost. So here the profit price is equal to profit is equal to price minus variable cost multiplied by units of output. Then you deduct your fixed cost. How about contribution margin? Contribution margin, this is the difference between the price, the selling price, and the variable cost. It is what is left over to cover the fixed cost and then add to operating profit. So contribution margin formula is equal to price per unit, your selling price, minus variable cost per unit. That is so-called as your CMU, contribution margin per unit. Example here, the company of UDevelop income statement. Assuming here the sales is 12,000 prints at 0.60. So we have 7,200. Less variable cost, 12,000 times 0.30. So we have 3,600. Variable selling price, 12,000 times 0.06. We have 720. So the total is 4,320. Now your contribution margin is 2,880. Less or you deduct your fixed cost equal to 1,500. So your operating profit is 1,380. Therefore, to compute your contribution margin, you have 2,880, your total contribution margin, divided by 12,000 units or 12,000 prints is equal to 0.24. Here, this in terms of dollar. In terms of peso, 0.24 per print or per unit as to CMU, contribution margin per unit. How about the break-even volume in units? So break-even is the point wherein there is no profit nor loss. So how to compute break-even volume in units? Your formula is fixed cost divided by unit contribution margin. So before, we have already computed here the unit contribution margin, which is equal to 0.24. So here, your break-even in units is fixed cost divided by unit contribution margin. So your fixed cost is 1,500 divided by 0.24. So your break-even volume in units is equal to 6,250 prints. So we have here as to sales in dollars, or you can use sales in pesos. Contribution margin percentage, or the ratio, is the contribution margin as a percentage of sales revenue. So contribution margin percentage, we have here 0.24 divided by 0.60, so equals to 0.40 or 40%. The break-even in sales in dollars. So, okay, we will continue.